Pay very close attention to the details that I give you in this video because it's going to highlight what's coming. I am going to show you what happens before it does. I've been highlighting this since 2020 as we saw China do a complete 180 from the rest of the world. What I'm about to show you, and then I'll connect it in with the second and third part of this video, is extremely important for the coming months. The very first and most important thing front and center is China's monthly credit creation. And you could see that it is basically a record high, the equivalent of almost $1 trillion worth pumped into the system in a single month. You have to understand how inflationary this is. The chart goes back several years to 2012. And what we could look at during these times is how much money is China pumping into their system, into their financial system at a time in which other countries are, restricting. China is doing the exact opposite. In 2020, I've highlighted this before. In 2020, every country, it seemed, was doing some sort of stimulus. They were throwing trillions here. They were throwing trillions there. And what did China do? Very little. Why was that? Well, we can speculate, we don't know for sure, but ultimately what the suggestion is that China was going to see a massive influx of capital because everybody wanted everything that China could make, and that would keep their economy going, their manufacturing, they're stimulating both domestic consumption and of course their exports. Then we had this turnaround where everybody started to tighten and China turned the engines on. So they timed it perfectly. Whether or not that was intentional, we don't really know. But they are doing something very different than the rest of the world. And now we have $1 trillion worth being pumped in, essentially using the banking system to get the loans going, to get financing happening. At the same time, the rest of the world is tightening. Do you see what they're doing? That's what this video is about, and I'll show you why that's important for you. Maybe you're in the US, maybe you're in Europe. I've got the charts for you. I've got the data. You don't see many other people covering this information because, hey, this isn't important. It's about China. No. When we start to realize it, it makes a lot of sense. You could see right here, this is the bank. This is China, okay? Bank long-term credit to businesses. This is advanced by 3 months. And then you look at the CSI 300. So there, imagine like the stock market, that's the blue line. And then you see how completely correlated these are. The chart goes back from around 2013 up until today. The more money they loan out, the more money that's pushed into the system, the higher the stock market can go. Is it perfect? Are there variants? Yeah, of course, as always. But that's the way this works. When money is being put into the system, stocks can go up. When it's being taken away, stocks can go down. And I had highlighted two very important aspects related to China. One is the fact that they were reducing the restrictions on the Chinese tech sector. That was important. And the second thing was basically getting out of lockdown mode. The market wanted these two things, and ever since then, it's been looking like China's stock market had done better. We'll see what happens, but that's as of now. China's M2 annual growth chart goes all the way back to 2012 up until today, and we can see that, it has been fluctuating, but essentially since the beginning of 2020, it's been up and away. That annual growth is up, and we have seen the positivity there coming through. They are doing a lot better than some other countries. They still have some growth, and that was during lockdowns. So imagine what they could have in the coming weeks and months. Now we look at this, I've highlighted it many times before. The Chinese property market is by far the biggest asset that we can see. It's $62 trillion worth. Always keep that in mind for why China needs to stimulate. They have, I've seen different reports, 30 million or 65 million empty homes, whatever the number is. I mean, it's a crazy number. They need to keep it going. It's very important for them. Europe, my friends in Europe, check this out, will get further boost from a resurgent China. So the black line, that's the Eurozone manufacturing PMI. And then we have the other line, which is China's real M1 year over year, deflated by the PPI, the Producer Price Index, pushed forward 6 months. All you need to know is that what they say here is these two are correlated, And then over a period of time, what we could see is China's pumping money in, Europe benefits as a result. One of those things, you've got Europe that manufactures a lot of the luxury goods. Those luxury goods make their way to China. China is a big buyer of Europe's luxury goods. That's just one point, and I wanted to highlight that for you, just to give you a little context. Whenever I show you a chart, don't get confused, don't get worried. Whatever I mention in that, that's the key takeaway. And in this case here, that's what you need to know. Capital outflow from China is improving rapidly. So you could see, oh yeah, a lot of cash was moving out, lockdowns, the tensions, everything going on. That has reversed here in the last couple months. And now you could see capital outflow from China has significantly improved. So all of these things add up. Okay, we'll see what happens in the coming weeks and months. Of course, I'll highlight that for you. And if you want to know more, simply subscribe to this channel and I'll bring you details every single day. Now, very interesting stuff here. The Financial Conditions Index, it's something that I've been highlighting recently. I want to make an entire video about it, and I've talked about it and what it is essentially. But it's a measurement of, how strict or how lenient, the money system is right now, the financial system is. And that's based on many different measurements using different things. It's not just like interest rates, for instance. There are different things. But anyway, the point is, in the last, let's say, couple weeks here, we've seen a reversal and it's starting to get a little bit tighter. I would like to see that trend continue. Why is this the case? Well, the reason it had gone down was the expectation, this is very important, that rate cuts would be coming fairly soon. Yes, they're tightening, but let's get ahead of the curve and we'll reverse that. Do you see what I'm saying here? Now, this week was not a very good week when you look at what happened with the markets, except for energy. Energy did very well. And you see that right here, that's the black line. All others were not looking so healthy. You could see the Fed's Harker saying that small rate hikes are on the table and opens door to cuts next year. So he's saying next year, but the Federal Reserve is always wrong on their timing. Think about this for a second. What is the purpose? Literally, what is the purpose of trying to increase interest rates and then almost immediately just cut interest rates? There's no sense in that whatsoever, but this is the plan. And knowing that, it already, they're saying, they've been hinting towards this. Different people in the Fed have been hinting towards the fact, yeah, we're going to have to cut pretty soon anyway. That's what the market is doing, trying to get ahead of it, and we'll see what happens. This means, of course, that it could push the markets up. I told you back in September and then October again that it looked likely that the October bottom would be the one, at least for this period. We'll see as the conditions go on, but that was it. How did I know? You could look at the expectation of rate cuts coming, and that was happening as of October timeframe. So right there, we had that information, and I hope you were on this channel. If you wanted to take advantage of it, it was right there. Now, what I'm highlighting right here is, as they say, it's an ugly chart, but the white line is the Fed funds rate for August 24, July 23, inverted, higher as more cuts are priced. And this is just showing us like a bunch of different things, but all bottomed in October and topped recently. This is all one big Fed trade, nothing else matters. So it's just more stuff and a little bit messy on the chart. The point is that whatever the Federal Reserve is doing, or the expectation of what they're going to do, matters more than anything. I call this the money mirror method. And I'm going to be highlighting this in a video. I want to get really good and dialed in before I present it to you, but it's the money mirror method. And if we follow that, we make the right investment choices. I've been accused of a lot of stuff over the years. My information is not helpful to people. I'm a fearmonger, doom and gloom, all this nonsense. But if you were actually take this information, you could utilize that. You could just be prepared and knowledgeable. If that's what you want, that's great. Or you could take it to the next level. And I've been able to bring the most precise and accurate data that is available, because it's just there. It's all there. If we pay attention, it is there for the taking. clock is ticking louder on a stock rally the pros never believed in. S&P 500 posted the worst week in 2023 as traders focused on rate risk. Pullback echoes one in August that saw stocks hitting new lows. This is just something we don't know. They're buying the dip right now. The point I wanted to interject here was that nobody really believes that the Federal Reserve is going to actually stay tight. Like, that's where it is. If they start to get what they call hawkish and we get the second wave of inflation potentially caused by what's happening in China, then all bets are off. Then we've got a big crisis potentially at hand, because that second wave of inflation, think about where we are in interest rates right now, things are getting tight. Imagine if we go to not just 5, but 6, maybe 7 to try to stamp that down. Now we're talking. But as of right now, markets, they're not worried. They're really not worried. Okay, that's the important point that I wanted to highlight. Now, really quickly, looking at oil, oil's another one that potentially right now, it's okay. WTI is sitting at around $80 a barrel, and Brent is at $86 a barrel, heading closer and closer to $100. We'll see if it gets there. Part of that is because of what's happening with Russia. Russia to cut output by 500,000 barrels per day. They're doing this, basically saying, you're putting this price cap. Okay, we're just cutting our production. In addition, this is just something, oil and rates relationship heads in new direction. Oil is no longer positively correlated to US real rates. These things are always in flux, but it's something unusual. I'm interested to see if this could be the potential for more inflation. So we've got the China factor, we've got oil. There's always those tensions there. There are always different things like speculation on top of all of that, but watch oil. Oil is obviously very important, along with other industrial metals and so many other things that I do cover here on this channel. So I'm showing you what could be happening here in the coming weeks and months. I hope that you found it informative. This level of detail is simply not available anywhere else. I know it could be boring sometimes. I know it could be like, that was a lot of charts, I don't get it. But I'm just trying to explain it as simply as humanly possible. If there's like, you want more detail about something, put it in the comments. I can't read your mind, so you have to let me know in the comments. I do take that all in right in here, and then I make a video or I interject that into a video that I do. I listen to each one of you. I've been doing this since 2011, and I've really put a lot of focus, and quite frankly, financially, at this point, it doesn't make sense to do the videos anymore, but I still want to do them because of my passion to help everybody out to learn what I've learned. Hope you appreciate that. Hit that subscribe button down below if you haven't already, and I will see you on the next one. Take care.